Silver is up by 40% this year and just broke $40 per ounce for the first time in 14 years. Is this the peak or could silver head higher? In this video, we look at why silver has rallied, whether the drivers are sustainable, how UK investors can get exposure via ETCs and miners, but also consider the silver market outlook. This video is sponsored by Lightyear, a UK investment platform with low and transparent fees that offers stocks, funds, and interest on uninvested cash. Let's begin by taking a good look at that rally. And year to date, the silver rally has been quite spectacular. In dollar terms, it's risen almost 40%. And in sterling terms, the strengthening of sterling versus the US dollar, the currency that silver's priced in, has taken some of the shine off that rally, but silver has still outperformed sterling-denominated global index funds, such as the State Street MSCI All Country World Index ETF, by quite a considerable margin. Here you can see that global index fund is up 6% year to date versus 27% for silver in sterling terms. Here we can see the price of silver and gold in dollars per troy ounce since 1963. Notice the broad resemblance in the shape of the curves, with peaks in 1980, 2011 and now. The two precious metals share many of the same drivers, and we'll discuss those in a moment, but some people look at the ratio of the gold price to that of silver as a signal for when gold will pull back or catch up with silver, and that's in the bottom panel. If we zoom in on 2025 so far, notice the dip in silver in April with the announcements of trade tariffs by the US. Silver has greater industrial demand than gold, so its price fell on expectation of weakening industrial demand, while gold rallied, and that's due to gold's safe haven status. Then, as expectations of demand for silver turned out not to fall in June, it rallied with respect to gold. So at the moment, it looks like silver is still a little bit underpriced relative to gold, even after the rally that we've had so far. Before we go on to talk about the drivers of the price of silver, how to buy silver, and the outlook for silver, today's video is sponsored by Lightyear. A few months ago, I visited Lightyear's office in London and had an amazing chat with their team, especially about fees and safety. Off the back of that conversation, Lightyear's now made their stocks and shares ISA completely commission-free, something I'm genuinely excited about. Fund manager fees and a 0.35% FX fee may still apply. They've also gone through a recent rebrand, keeping the same award-winning user experience, but with an even more premium look and feel. And to top it off, Lightyear recently raised $23 million in Series B funding from top European investors, and that's so that they can keep on improving and expanding their platform. If you're looking for a transparent, easy-to-use investment app with one of the best user experiences out there, Lightyear is definitely worth checking out. You can try Lightyear using the code PensionCraft or follow the link in the description to get up to $115 worth of a US fractional share in your general investment account. Terms and conditions apply. See the description for details. And remember, investing involves risk, and the value of your investments can go down as well as up. Now, silver and other commodities generally track inflation, unlike stocks that have had a persistent premium relative to inflation. So here, for example, is the price of silver in sterling, in pounds, and the UK CPI inflation index. Now, before 1988, I had to use RPI inflation, so I joined together the two series. And this looks at a period of 54 years. Now clearly, sometimes the price of silver has far outstripped CPI inflation and sometimes lagged well below it, but if we look at the average inflation rate, it looks like it's not too dissimilar to the growth in the price of silver. The premium, if you annualize it, is less than 1% over this many-decade period. Now in PensionCraft, we've got a fair value model that takes inflation as one of the inputs. It also includes two other factors. The first one is the value of the dollar versus a basket of its trading partners. Now, when the dollar's strong, that tends to weaken commodity prices, and that's because commodities, by convention, are priced in dollars. The final factor is the US real 10-year interest rate, and the reason why that's in there is that both gold and silver are wasting assets. They don't generate an income, and when interest rates are high, that tends to be something that drags down the price of silver and gold. Now, for PensionCraft Premium members, you can use this model on our website, and this is what it's currently saying for silver. The model's saying that the fair price for silver using the factors we've discussed is $37.80 per ounce, and the actual price of silver is $42 as I make this video. So that means it's overpriced by about 11%. Now, what really sets silver apart from gold is greater industrial demand. Whereas about 60% of total demand for silver is for industrial uses, gold's industrial demand is just 7%. Silver is the world's best conductor of electricity, so it's vital for electronics, from smartphones to electric vehicles. Solar panels are another huge growth area, with silver paste carrying the current in most photovoltaic cells. It's also used in solders, brazing alloys, and high-performance batteries, while its antibacterial properties make it essential in medical coatings and also water purification. Beyond that, silver acts as a catalyst in plastics and chemicals, and its reflectivity powers mirrors and energy-efficient glass. In short, silver is a critical material for modern technology and the clean energy transition. I think solar panels deserve a special mention here, as that's where silver demand is growing fastest, and that's partly due to a more efficient solar panel technology called tunnel oxide passivated contact, or TOPCon. TOPCon cells typically require more silver paste per watt than older PERC cells, and that's because of the metallization design. And that's especially on the front side contacts. As TOPCon adoption ramps up, it could increase the amount of silver that's used per solar cell, even though manufacturers are trying to scrimp on the amount of silver that they use per cell. And the reason why this is such a key point is that analysts estimate that with the rapid scaling of TOPCon, especially in China, solar could account for 20% or more of annual silver demand by the end of this year. Now let's turn to supply, and here we have to think about where silver is found. Now, silver is rarely found on its own in nature. Instead, it usually occurs alongside metals like gold, copper, lead, and zinc, and that's because they form under similar geological conditions, and that's due to the similar physical properties of those metals. Now, a warning to the physicists who are watching this, I'm going to use the C word now, and that word is. And you can see which metals have similar chemical properties because they tend to sit together here on the periodic table. What this means in practice is that most of the world's silver is actually produced as a byproduct of mining for those other metals rather than dedicated silver mines. For example, Peñasquito in Mexico is one of the world's largest gold and silver mines, but the numbers show clearly that silver is produced as a byproduct here. In recent years, the mine has yielded around 871 tons of silver per year, alongside roughly 12 tons of gold. By weight, the operation is dominated by base metals like lead and zinc, which are produced in the hundreds of thousands of tons, while silver makes up less than 0.5% of the total metal mass. The crucial knock-on effect is that silver supply isn't driven solely by silver demand or price. It's heavily influenced by the production cycles of copper, lead, and zinc. Even if silver prices surge, miners won't necessarily ramp up output unless the economics of those base metals justify it. And that creates unique supply constraints and volatility compared to metals mined primarily on their own. In fact, despite the surge in the price of silver, the supply of silver has been below demand now for several years in succession. So how can we get exposure to the price of silver? Well, probably the simplest way is to buy a physically backed silver fund. These can be held in UK ISAs, SIPs, and general investment accounts, and there are several to choose from here in this table from Just ETF. Here are the sterling denominated exchange traded commodity funds from that table, and you can see that their returns are almost identical, and that's simply because they all own the same thing. Personally, I probably choose the ones with the lowest fees. Another option is to invest in funds that hold silver mining companies instead of the metal itself. The exposure here is indirect because miners often produce gold, copper, or other metals as well. The upside is that many of these companies pay dividends and you benefit from the equity risk premium as well, which physical silver can't provide. Mining shares can even act like leverage plays on silver, sometimes rising more than the metal itself in a bull market. But there are trade-offs. Miners face operational and political risks, their performance is tied to the broad stock market sentiment, and in an equity market downturn, they can fall sharply regardless of what happens to the price of silver. Here's a list of those funds which buy silver miners from ETF Atlas. Only one of those silver miner ETFs, to my knowledge, trades on the London Stock Exchange in sterling, and that has the ticker SILG. Now, of course, none of those funds were recommendations, and you should always do your own research when it comes to choosing funds. In the UK, some precious metals can be sold free of capital gains tax, and that's because they're classed as legal tender. That's why gold sovereigns and Britannias are so popular. As Royal Mint coins, they're exempt from capital gains tax. The same rule also applies to silver Britannias, which carry a £2 face value. That makes them legal currency and therefore tax-free on disposal. But if you buy other silver coins, bars or rounds that aren't UK legal tender, any profits that you make above your annual allowance for capital gains tax could still be subject to CGT. Let's end with the outlook for silver. Here you can see a variety of forecasts by silver analysts, and some of them suggest that silver could test its historical highs, and that would push it to prices of around $50 an ounce later in 2025. However, notice that there's a broad dispersion in the forecasts because, of course, nobody really knows what's going to happen to silver. For example, if the Federal Reserve cuts interest rates, as many people expect, that could provide support for silver. Still, there are clear risks after such a sharp rally. For example, there could be profit-taking or consolidation, and of course, silver tends to be more volatile than gold. And policy surprises from the Federal Reserve, or alternatively renewed dollar strength, could easily reverse the gains that we've seen. So hopefully that's given you some insight into how silver's priced, what its drivers are, how to get exposure to silver, but also where silver might be headed after this huge rally in 2025. Now don't forget the sponsor of today's video, Lightyear. You can try Lightyear using the code PensionCraft, or you can follow the link in the description to get up to $115 worth of a US fractional share in your general investment account. Terms and conditions apply. See the description for details of those. And remember, investing involves risk and the value of your investments can go down as well as up. And, as always, thank you for listening.